Hey everyone, and welcome back to the channel. Today, we're going to talk about something that might sound a little, well, boring. But I promise you, by the end of this video, you'll agree that boring is the new exciting, especially when it comes to your money. The biggest secret to building wealth isn't a secret at all. It's just not sexy enough for the headlines. It's this: boring money will always beat exciting money. Think about it. What gets all the attention? The friend who supposedly made a fortune overnight on some obscure crypto coin. The headline screaming about a tech stock that shot up 500% in a week. The get-rich-quick schemes that promise you financial freedom by next Tuesday. That's exciting money. It's a roller coaster. It's high drama, high stakes, and high anxiety. It makes for a great story at a party, but it's a terrible strategy for your life. Why? Because for every one person who gets lucky, there are thousands who get wiped out. The roller coaster goes down just as fast as it goes up, and most people can't stomach the ride. Now let's talk about boring money. What does that look like? It's your automatic monthly contribution to a low-cost index fund. It's patiently reinvesting your dividends. It's maxing out your retirement accounts year after year without even thinking about it. It's making an extra payment on your mortgage. It's watching paint dry. It's the financial equivalent of eating your vegetables and going to bed on time. There's no adrenaline rush. You won't be bragging to your friends about the 0.5% gain you made last week. It's quiet, it's slow, and it's repetitive, and you know what? It's the most powerful force in the financial universe. The magic behind boring money has a name, and you've definitely heard it before: compounding. Albert Einstein supposedly called it the eighth wonder of the world, and he was right. Compounding is your money making babies, and then those babies grow up and make their own babies. It's an exponential curve. In the beginning, it feels incredibly slow. Your first $100 earns you a few bucks. Who cares, right? Your first 1,000 earns a little more. Still not life-changing, but you keep at it. You keep adding consistently, month after month, year after year. Let's run some simple numbers. Imagine two friends, Alex and Ben. Alex is the exciting investor. He jumps on every hot tip. He buys high, panic sells low, and chases the next big thing. Over 10 years, he might have a few big wins, but his portfolio is a chaotic mess of ups and downs. Maybe he ends up with a little more than he started with, maybe a little less. He's stressed out, constantly checking his phone, and his financial future is a giant question mark. Now, let's look at Ben. Ben is the boring investor. He decides to invest $500 every single month into a simple, diversified S&P 500 index fund. He sets up an automatic transfer and basically forgets about it. He doesn't check the market every day. He doesn't panic when the news reports a downturn. He just keeps contributing $500 a month. After 1 year, Ben has invested $6,000. Assuming an average annual return of, say, 8%, he has a bit over $6,000. Nothing to write home about. After 5 years, he's invested $30,000. His account is now worth around $36,000. Better, but still not yacht money. But here's where the magic starts to accelerate. After 10 years, he's put in $60,000, but his portfolio is worth nearly $90,000. That's $30,000 of pure growth, earned while he was living his life. Fast forward to year 20. Ben has contributed $120,000 of his own money, but his account, it's now sitting at nearly $290,000. More than half of his wealth is pure profit from the market, and by year 30, he's put in $180,000, but his account has exploded to over $700,000. The last 10 years of growth were way more powerful than the first 20 combined. That's the power of the compounding curve. That's boring money in action. Alex, the exciting investor, is likely still chasing trends, probably with a fraction of Ben's net worth. The biggest mistake people make is interrupting this process. They get impatient. They see their boring index fund chugging along at 8 or 10% a year, while some hyped-up stock just tripled. FOMO, the fear of missing out, kicks in. They pull their money out of their slow and steady strategy and throw it at the shiny object, usually right at the peak of the hype. And that's how you lose. You reset the compounding clock. You trade a proven, long-term strategy for a short-term gamble. Building wealth isn't a race, it's a marathon. And in a marathon, the winners aren't the ones who sprint the fastest at the beginning. They're the ones who maintain a steady, consistent pace for the entire distance. Your financial journey is the same. The goal isn't to find the one magic investment that will make you a millionaire tomorrow. The goal is to build a system, a set of habits, that will inevitably lead you to wealth over time. So how do you embrace the boring? First, automate everything. Set up automatic transfers from your paycheck to your investment accounts. This removes emotion and decision-making from the equation. The money is invested before you even have a chance to spend it or second-guess your strategy. It becomes a non-negotiable part of your financial life, just like paying your rent or mortgage. Second, choose your boring investments. For most people, this means low-cost, broadly diversified index funds or ETFs. These funds don't try to beat the market. They simply aim to be the market. You own a tiny slice of hundreds or even thousands of the world's best companies. You're not betting on one horse, you're betting on the entire race. Over the long term, that's the safest and most reliable bet you can make. You're betting on human innovation and economic growth as a whole. Third, and this is the hardest part, be patient. Tune out the noise. Your cousin will tell you about the new digital currency he's all in on. The financial news will flash headlines designed to make you panic. Your social media feed will be full of people flaunting their supposed overnight success. Ignore it, stick to your plan, read a book, go for a walk, focus on your career, your family, your hobbies. Let your money do its quiet, boring work in the background. The less you tinker with it, the better it will perform. Think of your investment portfolio like a bar of soap. The more you handle it, the smaller it gets. The truth is, the people who are truly wealthy often don't talk about it. Their wealth wasn't built on a lucky gamble. It was built through decades of disciplined saving, consistent investing, and letting compounding work its slow, silent, unstoppable magic. They drove reliable cars, lived in modest homes, and focused on the long game. They chose boring, so I challenge you, fall in love with boring. Get excited about your automatic monthly investment. Celebrate the quiet discipline of sticking to your plan. Find joy in knowing that you are building a secure, prosperous future for yourself, one slow, steady, and wonderfully boring step at a time. The path to financial freedom is paved not with lottery tickets and hot stock tips, but with consistency, patience, and the beautiful, powerful force of boring money. That's all for today. I hope this helps you reframe how you think about building wealth. It's not about the thrill of the chase. It's about the peace of mind that comes from a solid, dependable plan. If you found this useful, give the video a like and consider subscribing for more no-hype financial content. Thanks for watching, and I'll see you in the next one.